Patterns are not drawings on a chart. They are footprints of fear and greed. When prices rise too fast, it's not because of logic. It's because the crowd believes it will never stop rising. When prices collapse, it's not because of reason. It's because that same crowd suddenly believes it will never rise again. The trader who learns to recognize these emotional extremes doesn't need to guess the next move. He simply waits for the inevitable reversal. The market always swings between optimism and despair. That's the only rhythm that matters. You see, every chart tells a story. It begins with disbelief when the market starts to rise, and few believe it's real. Then comes acceptance, when more join the move, afraid of missing out. And finally, euphoria, when even the skeptics surrender, convinced that prices can only go higher. That's when the market begins its cruelest trick. It stops rewarding hope and starts punishing greed. The same pattern repeats in every crash, just inverted. Fear gives birth to opportunity. Hope gives birth to loss. The wise trader doesn't react. He observes. He doesn't predict. He interprets. I used to watch the tape for hours, not looking for numbers, but for rhythm. A slow tape told me the market was indecisive. A fast one meant emotion had taken over. When the ticker suddenly accelerated without news, I knew the crowd was acting on impulse. And when it slowed down after panic selling, I knew fear had peaked. That's when I moved. Timing, as I said, hides in plain sight, in the pauses, in the exhaustion of momentum, in the hesitation before reversal. The tape spoke to me because I had learned to be quiet long enough to hear it. Most traders don't fail because they can't read charts. They fail because they don't understand what those charts represent. The market doesn't care about your analysis. It cares about behavior. When everyone sees the same setup, it's already too late, because the crowd's reaction to that setup has already been priced in. The best opportunities are born not from clear signals, but from confusion. When the majority doesn't know what's happening, the minority who does makes the money. There's a rhythm to every market cycle, a heartbeat that repeats across decades. The instruments change, from ticker tape to digital screens, from human brokers to algorithms. But the essence remains the same. Price moves in waves because human emotion moves in waves. After every surge comes exhaustion. After every panic, relief. I learned to see these phases not as random movements, but as psychological stages. The accumulation, the markup, the distribution, the decline, each phase whispers the same message. And nothing lasts forever. Many traders ask, when should I buy? When should I sell? But the real question is, when are others about to act emotionally? The answer lies in the language of the market. When you sense overconfidence, danger is near. When you sense despair, opportunity approaches. It's not magic, it's observation. The market tells you everything you need to know, not through forecasts or theories, but through behavior. Watch what traders do, not what they say. I've seen markets at their wildest. The roaring bull runs that made men millionaires overnight, and then broke them just as fast. I've seen crowds screaming for more when the market was already dying inside. And I've seen silence. That eerie stillness after a crash, when no one dares to buy. But silence is the market's deepest truth. When noise fades, clarity appears. When it quiets, logic returns. The best traders read this dialogue the way a musician reads notes. They sense when the melody is about to change. It's about waiting for the right setup, the right confirmation, the right moment when probability and patience align. But waiting isn't natural. The human mind is wired for action. Crave movement. We crave to do something, anything, to feel in control. Yet the market punishes impatience more than any other sin. Jesse Livermore once said that it was never his thinking that made him the big money. It was his sitting, his waiting. The truth behind that statement is deeper than most traders realize. The act of waiting isn't just physical, it's psychological torture. Every tick on the tape tests your belief. Every small retracement whispers fear. You start to question your conviction. What if I'm wrong? What if this time is different? The market has a cruel way of magnifying doubt. And once doubt creeps in, discipline begins to decay. You see, most traders don't lose because they make bad trades. They lose because they can't hold on to the right ones. The moment a trade turns slightly against them, they panic. The second a trade starts to work in their favor, they grab small profits out of fear of losing what little they've gained. They never give their positions time to mature. The greatest enemy of profit isn't the market. It's the trader's own mind, restless and afraid of uncertainty. Livermore understood this intimately. He learned that emotional control was far more powerful than any chart pattern or system. He called it a mental poise. Without it, even the best analysis is useless. He knew that the market will always tempt you to break your plan, to take early profits, to chase after missed moves, to double down in desperation. The key is to resist that instinct, to master the art of doing nothing when nothing should be done. But how many can truly do that? How many can sit through the storm without touching the wheel? The psychology of waiting is brutal because it exposes who you really are. It shows whether you can handle uncertainty, whether you can endure silence without breaking it. Patience in trading isn't passive, it's active restraint. It's having the courage to trust your process even when your emotions are screaming otherwise. Every professional trader knows this. The market isn't a test of intelligence, it's a test of emotional endurance. Fear, greed, hope, regret, these four emotions form the cycle that destroys traders. Fear keeps them from entering good trades. Greed makes them over-leverage. Hope keeps them from cutting losses. Regret drives them to chase. It's a loop that spins endlessly for those who haven't learned to control their minds. Livermore said that the market is designed to fool most of the people most of the time, but it doesn't do this through manipulation. It does it through psychology. The market reflects human behavior, and as long as humans are driven by emotion, their results will remain predictable. Every chart, every tick, every swing, it's not just price movement. It's a visual representation of collective emotion. When the crowd feels euphoria, price rises. When fear spreads, it collapses. But timing the market isn't about predicting these emotions. It's about observing them without being consumed. Livermore knew that when you can separate your emotions from the crowd, you gain an almost unfair advantage. You start to see what others can't, not because the data changes, but because your perception does. This separation, however, comes at a cost. It means loneliness. It means waiting when everyone else is trading. It means watching others celebrate quick profits while you sit quietly, holding your conviction. Most traders aren't built for that kind of solitude. They want excitement. They want validation. But the market doesn't reward excitement. It rewards discipline. The ability to stay still while everyone else moves is the closest thing to a superpower in trading.